Hi, I'm Jonathan Wild, and today we cover how to account for installment notes with annual payments. An installment note is a type of note payable that involves issuing a note in exchange for cash or other assets. In return, the issuer promises to pay back the principal of the note with interest through a series of payments to the lender. Notes are different than bonds in that they are usually issued to just one lender, like a bank, whereas bonds are typically issued to hundreds or even thousands of people. All right, let's run through an example of an installment note with annual payments. So assume a company borrowed $10,000 cash from the bank on January 1st. In exchange, the company signs and issues an installment note to the bank with 6% interest and 5 annual installment payments of $2,374 that include interest and principal. For the company to record the issuance of the note, we debit cash for $10,000 and credit notes payable for $10,000. Next, each installment payment is made at the December 31st year end for each year of the 5-year loan. However, when recording the installment payment, we need to determine what portion of the payment goes towards accrued interest expense and which portion goes toward paying down part of the amount borrowed or the principal of the note. To do this, we use something called an installment note amortization schedule. So let's set up the table. First, let's add a column for the period end or payment dates. The note was issued on January 1st of year 1, so the first period end payment date is December 31st of year 1. It is a 5-year note, so we enter in December 31st for each of the 5 years. The next column is the beginning balance for each annual period. In the first year, it is $10,000 as the note was just issued. The next column is interest expense, which is computed as the beginning balance multiplied by the interest rate of 6%. In year 1, $10,000 is multiplied by 6% to get $600. This means that in year 1, $600 of the $2,374 installment note payment is interest expense. The next column determines the portion of the installment payment that reduces the principal that is owed. This is computed as the $2,374 installment note payment minus the $600 interest expense to get $1,774. This amount goes towards paying back the principal amount borrowed and therefore reduces the notes payable account balance. The next column is the cash installment payment of $2,374 for each of the next 5 years. The last column is the ending balance, which is the beginning balance of the note minus the amount of the installment payment that went towards paying back principal. In year 1, this is $10,000 minus $1,774, which gets us an ending balance of $8,226. Now, to begin year 2, we take the ending balance from year 1, and this becomes the beginning balance for year 2. We apply the same procedures as we did in year 1 to year 2, and then further to year 3 and year 4, and finally year 5. This completes our amortization table for the 5-year note. Next, let's record each of the installment note payments, which is much easier after doing the amortization table. So, for December 31st of year 1, we record a debit to interest expense for $600, a debit to notes payable for $1,774, and a credit to cash for $2,374. The debit to interest expense increases that expense account and reflects the annual interest on the note. The debit to notes payable reduces the balance in that liability account, recognizing that we have now paid back a portion of the principal of the note through an installment payment. We credit cash for $2,374, as this is the installment payment amount made at each period end. For the year 2 installment payment entry, each of the account titles remain the same. Just the amounts will change based on the numbers we pull from the amortization table. The same is true for year 3, year 4, and year 5. At the end of the 5 years, the note is paid off through installment payments, and the final balance in notes payable is 0.